Okay, hello everybody and welcome to this IC Markets Live webinar. My name is Chris Wilson, I am from Trade with Precision and I welcome you on here this morning for me. Please excuse my croaky voice, it is 7 AM in the morning for me. Hopefully that sorts itself out over time, but I do apologize for that. I assume most of you are in the US-Canada region. If you've been on any of these webinars before, you'll know the drill, what I'm about to ask you. Just if you wouldn't mind typing into the question box that you can hear me. You can see the screen, all stuff like that, just so I can make sure that I'm not sitting here talking to myself, which would be highly annoying. I will also apologize for a bit of a cough that I've got. I'll try and keep that at bay throughout the course of the webinar. Awesome, thank you, Leon. First cab off the rank, thank you for that. There's not too many on the webinar today, which is really good actually, because what it means is that we can keep this, you know, as interactive as we possibly can. So if you have any questions throughout the course of the webinar, please do just type them into the question box, and I'll answer them throughout the course of the webinar. If we happen to get too many, I might have to divert them till the end, but I think we should be fine with the amount of people that we have on. Also, there's probably a range of expertise on the webinar as well. So if you have a question, chances are somebody else has the same question as well. Also, it's not a particularly well-structured webinar. It's really, it doesn't have a huge slide deck. It's really only got an agenda page. We're going to talk about candlesticks, and then it's basically just a live market looking at the platform. So I'll spend a little bit of theory time on candles and what they are, but the bulk of the time will be spent, looking through the markets, trying to analyze patterns, and as the title suggests, spotting opportunities in the marketplace. Again, I do apologize. Okay, so cracking on, first thing I need to do is flash up this risk disclaimer for you. I'll give you a couple of minutes to digest that information while I have a sip of tea here and try and improve my voice. So if I could summarize that, it's basically saying, we're not putting out trade calls here. We're just doing this for educational purposes only. There is a lot that goes into trading the markets, a lot of education and practice. So wouldn't suggest taking a trade based on what you hear from me today. We're just looking at what we see. And also just be really aware that there's risk involved in trading as well. Like any leveraged product, can be really good on one hand, but really bad really good on the way up, say, but really bad on the way down. Similar to, say, a mortgage on a house. If any of you can understand the concept of, say, having a $20,000 deposit on a $200,000 house, which is wonderful leverage there, but then the house market falls and suddenly your house is worth $160,000. Well, not only have you lost your deposit, but you also owe the bank another $20,000. So that's how it can work negatively. So you really do need to be protecting yourself against risks like that by having stop losses in place and other factors as well. So certainly don't be jumping into the markets before you fully understand the risks of that. Oh, move ahead. Okay. So this is the agenda. Really simple. Just 3 points. How to set up your charts and candlesticks on multiple time frames. So we'll look at the charts for that. Understanding candlestick patterns and trends to find trades. So what are candles? How do they work? What are candlestick patterns? What does the color of a candle tell you? What does the shape of a candle tell you? All of that sort of stuff, really general. And then live demonstration on finding trades using candlesticks, basically just looking through all the charts, seeing what we see. You know, as someone who trades for a living, a technical trader I am, there was obviously a lot of moves at the start of this week on Monday. And typically what happens is after a period of, you know, a move on the markets, then you get an overextension and you get markets that need to retrace before they decide what their next move is. So the stage of the market is really important as well. And another thing I'll say is, if you'd like me to check particular markets, please do have them handy, and I'll have a look at however many markets we can possibly look at. So that's basically it for the slide deck. And as I say, the rest of it, NASDAQ. Oh, Diana is saying the NAS 100, absolutely. I will have a look at that. But before we go to much further, let me just bring up the IC Markets platform. Okay. Can I do that here? Okay, let me just, this is a practice account, so let me just figure out how certain things may not be available on this form. 2 seconds. Funnily enough, the NASDAQ is not showing up for me. I do apologize. Everything else is. That's the Dow, the S&P, the FTSE. Oh, maybe that's it. US Tech 100. Oops. Tell me if that looks like the NASDAQ to you. Here it says US Tech 100, which could very well be the NASDAQ. But I'll get back to that. Let's just talk about candlesticks in broad terms, first of all. So, you know, the candles by their very nature are Japanese in nature. And if any of you have studied Japanese, they have, you know, they use hundreds and hundreds, probably thousands of Chinese characters. And you are considered sort of knowledgeable, I guess, or wise in Japan, the more you know. Candlesticks seem to follow the same pattern. They have multiple names, dojis and shooting stars and all of that for different types of candles, you know, what they look like, whether they're red, whether they're green, how long the tail is, how long the wick is. Obviously a candle has a wick, like a proper candle, so that's what you call the wick. And then you've got a tail as well. How big the body is in relation to the full extent of the candle. They all have names, you know, based on those certain characteristics. But at the end of the day, rather than remembering all that, it really is just important to know that really a candle can only be one of three things. It can be bullish, bearish, or indecisive. Much the same as when you look at a chart like the euro-dollar monthly, you can tell that this is going down, like for the past 1, 2, 3, however many, I don't know, almost a year, probably more than that. This pair has been going down, in other words, bearish. So if it's on the way down, it's bearish. If it's on the way up, it's bullish. Now, why? Because in theory, bulls charge and bears are slow. Now, if you're from Canada, you probably don't agree with that, but that's the idea behind bullish and bearish. So really, a candle can only be one of these three things anyway. Bullish is green, essentially, or let's just say top heavy. You can actually have a bullish red candle if it's got a really long tail. Let's this one. This one here, even though that's red, I would call that more bullish, because what's happened here is you've started the session, and this is a monthly chart here. So each candle represents a whole month. Where are we here? Each candle represents a whole month's worth of trading. In this case, we're back in August of 2018. Where it started that month is at the top of the body of this candle. Throughout the month, it's been all the way down to the bottom of the tail, all the way up to the top of the wick, but it has finished the month lower than it started, slightly lower than it started, hence why it's red. But the fact that it has rejected all of this lower pricing, like it's tried to go down and failed, means it is slightly bullish, or it is more bullish than bearish. Now, it has followed with it. And funnily enough, it has followed with a more bearish candle, even though it's green, okay? Because it is like, you'd call that bottom heavy, wouldn't you? Same kind of scenario in that the body of the candle in this, I hope you can see that, the body of the candle in this example is really, really small, as in just, you know, basically a horizontal line. So it has started and ended the month at the same price, but it has tried to get all the way up here, failed, and come back down. Yes, it did try and test some more price action down at the bottom and failed as well, but it is what you'd call bottom heavy. So I would actually consider that more bearish than bullish. So colors are important, tails are important, wicks are important. Really, it's one of only three things. Now, indecisive would be this sort of thing. Now, when is that? Funnily enough, yes, of course, you'd expect that. This was March of 2020. You'd expect that to be an indecisive month, wouldn't you? We all know what happened in March of 2020. So in that month, you had massive shocks to the market. So again, this is one candle in a whole month. We're looking at a monthly chart. So, and it's massive in terms of, in comparison to the candles around it. So you've had big moves this month. You've been all the way up here, all the way down here, but you've ended the month pretty much the same place as you were at the start of the month. So, you know, big news announcements or big world events like COVID, you know, the pandemic, are going to, you know, just shock the markets. They're going to shock the markets and they're going to move around, but ultimately they don't really change the direction. Certainly not in the moment. I mean, they can change the direction, but you can see certainly it hasn't here. After the shock of all of that, the natural market momentum tends to carry on in a lot of cases. So essentially what I'm saying here is three options really: bullish, bearish, or indecisive. That really is the only options that you can have. So when you hear people talk about, you know, dragonflies and dojis and spinning tops and all of that sort of thing, high waves, I think, is another one. You know, if you want to get into that, great, but at the end of the day, I think they all fit into three broad categories. Because as a trend following trader, when you're looking at the markets, that's really the first thing you're trying to gauge is the sentiment. Are we going up or are we going down? Because there's opportunities either way. But as long as it's not going sideways, if there's going sideways, then it's, you know, kind of nothing to see here, folks. So the key characteristics of candlesticks are the color, as I mentioned before. It's red if the body of the candle represents where it started and where it ended the month. So if it's red, it just means it finished the month lower than it started. And if it's green, obviously the opposite. It finished the month higher than it started. Candle size is really important too. That tells you, well, a whole bunch of information. We'll get to that. The other thing is the location and the size of the wick, like how long the wick is, how long the tail is, and the location within the trend, I suppose. Like if you're in well, we're obviously in a trend here. We're in a downtrend. So is the candle at the start of a trend, or is the candle at the end of a trend? The other thing you want to assess is the relationship of the candle to where the moving averages are. Here you've got the 10, 20, 50, and 200 period moving average. You want to know how far away from the candles, from the moving averages, the candles are, because that obviously tells you how advanced the trend is, I guess, on that particular time frame. So let's, so normally small candles usually form before a move occurs. So when you have, let's move down to the, let's see, how will we explain this? First of all, when you're looking at this, the fact that the candles are a long way from the 10 period moving average here means effectively that this trend is moving too fast to capture on the monthly chart. So if you move down to the weekly chart rather, then you can see more evidence of it acting as trends behave. So how a trends behave is like pretty much what, waves on a beach. You have a push down and a pullback, a push down and a pullback, a push down and a pullback constantly until the trend ends, I guess, or stops. Now, what you're looking for is to get in at the start of one of those waves, I guess you'd call it. So you're looking for it to effectively, first of all, establish a downtrend. And what we're looking at here is obviously an uptrend. An uptrend is a series of higher highs and higher lows. There's a high, so low, up to a high, pullback, up to a high, pullback, up to a high, pullback, up to a same high, or more or less the same high. Okay, now that's a signal that that trend is weakening. Well, first of all, actually, the overextension from the moving averages here is an indication that the trend is coming to an end. See how you've pulled up and pulled back into the moving averages, that space between the 10 and the 20 period moving average here, and then you've pushed up again, and instead of moving back into the moving averages, you've moved too far back. And then you've made a slightly low, if not equal high. Okay. I'll get to indicators later. But then what you've done is you've broken the previous low. At the point that you come down here and go lower than this low here, this low, which is about 118, when you break that low, you are officially in a downtrend because you've made a lower high and you've now made a lower low. A lower high than that, a lower low than that. So you are now officially in a downtrend. So the first opportunity to pull back is generally a really good one. So, excuse me 1 second, I'm going to have some more tea. What you see here is, let's just look at the candles for a minute, because that's effectively what we're focusing on. When you have a pull up, a push up, you're getting this momentum, you're getting this big candles, big green, generally big green candles, but then you see that kind of stops. First of all, this, as I said before, even though this is red, it's top heavy, it's still got a lot of upward momentum, and then you get a slightly more bearish candles at the top. As I say, even though they're green, still moving up, but rejecting that previous high. You can see that it's starting to reject that previous high already. Then you get a definite bearish red candle. That is okay. So again, this is a weekly chart. So you are only getting one candle a week. So you have time to assess the strength of this market. You are struggling at the previous high. You are giving yourself a red candle. The break below of that red candle would obviously mean that push to the upside is over. And when you've established that, everyone piles on. Okay, you often get big moves after small moves after, and think about how a wave washes up onto the beach, crashes up, turns around, crashes down, crashes up, so it's the same kind of concept. So before, so you get this period of a little bit of indecision, end of one trend to the start of another. So usually small candles form before a big move occurs. So large candles. Now, what you don't want it to be doing is seeing, you're at the end of this candle here. This candle here is sorry, and forgive me, I haven't looked at the questions for a while either. I will do that in a minute. This is, where are we? June of 2021. When you're sort of at the end of this month and you think, oh my goodness, there's all this movement to the downside, that is not the time to pile on, because that move has it's already expended a lot of energy getting that far. So that move may be very close to the end. So basically, pretty much amateurs jump into the market when a trend is reaching the end of its run. Professional traders are selling out by that point. So, essentially avoid trading big candles. You want to be getting in when, small candles are giving you the impression that another move is coming. And so the best sort of, so now we've established a downtrend, lower high, lower low, pull back into the lower high again. And when these moving averages start to cross over like that, when the 10 obviously is going to move. First of all, what are moving averages? Everyone know? I'll just explain that really quickly. This here is the 10 period moving average. This is the 20, this is the 50, and this is the 200. Now, what do? They basically, at each point on the on this average, the value of that is taken from the last 10 candles. So the current one, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So the last 10 candles, the average value of all of those candles is plotted here. Similar to 20, it's the last 20 candles, the last 50 candles, and the last 200 candles. So this gives you a picture of what the momentum is over the short, medium, and long term. And it's really good to make sure that you have all, at least short and medium term momentum moving the same direction, because that pushes, that gives you more likelihood that as price does pull back into the moving averages, as in take an uptrend on the, as I say, this is a weekly time frame. So if you were looking at this piece of chart action here, these two green candles, that's obviously going to look like an uptrend on the, let's say, the hourly chart, if you were to zoom down to the hourly chart. But you don't want to be trading a pullback. I mean, you can trade pullbacks, but far better trading opportunities are to get into a downtrend when the higher time frames are pushing in that direction. That is much sort of higher probability trading. Yeah, so you really want to get in when it's sort of in that what we call the sell zone. But a move has ended, right? Two very bullish weeks followed by a very bearish week. Back in between the 10 and the 20 period moving average, a break below the low of the weekly with a stop above the high, ride the next wave. You can keep doing that until that trend finishes. Now, I will check questions. I want to talk about MACD and RSI as well, but I will just see if there's any questions. No, there's not. So I guess you're all change the trend, says Diana. Absolutely. Oh, well, I guess that all makes sense. That's good. So I guess what I'm trying to say is that's how candles work. And I want to, the other thing, let's talk about the two indicators that we predominantly use, which is the MACD and the RSI. Now, First of all, if you want to add any of this to your charts, 2 seconds. Insert indicators. Okay, so if they weren't there, your moving averages are found here. So you basically just put them up. Well, bring them up. You can select the period. You can select the color. As I say, what I use is 10, then put a 20 on, then put a 50 on, then put a 200 on. I mean, the colors we use are up to you, but really sort of a gray, blue, red, green in that order. Insert MACD is right there. I'll explain that in a minute. And RSI is relative strength index, which is right here. When you click on them, it just brings them to the bottom of the chart. You can size them as you wish. How do you use these? Right. As a trend following trader, the first thing you're trying to establish is what's the direction of the market. Are we up or are we down? When you're looking at a market, when you're looking at a candle, that's you're trying to establish where is the momentum, because you really want to trade with the momentum. Trading with the trend is really the key. Why try swimming upstream unless you're a salmon? It's harder. Yes, you can trade pullbacks. Yes, you can trade pullbacks, but they are certainly harder, and I don't honestly know why you'd bother if there's good opportunities. It's better to wait for opportunities. Let me give you an example of trading that we've had already this week. So been a lot of action on the Aussie US and the Aussie crosses at the start of this week. First of all, you're looking at the start of the week, you're sort of looking at the higher time frames, trying to get an assessment of where's the momentum. Are we up or are we down? Now, clearly here, we're in the month of October. This is a monthly chart, but I'm looking at starting to trade at the beginning of the week. So I can clearly assess that this is a bearish market. Bearish candles, bearish market. What I can see though is we're overextended from the moving averages. That's the first thing I want to note. So just obviously be aware of that. In terms of the monthly chart, we're overextended from the moving averages, and the further the price action gets from the 10-period moving average, or the 20, or that zone rather, the higher the chance of a snapback. Okay, but you do have to move down the time frames to see, what is the momentum of this push down, which we'll get to. That's about all I can take from that. The other thing you get a crosshair here and is really interesting. Are there any support and resistance areas coming up? There's really only that at about 61 that you'd be worried about. There's pretty much clear space until there. Hold on. Oh, let's call it 63. Well, which is where we are now. So there is a bit of a level where we are now, because you can see here, where are we? This is the global market, the global financial crisis, all the way up, crashed down here. The global market crisis ended where we are now, right now. So that is obviously a big support level, okay? You'd be a little worried about breaking that level when you're so far away from the moving averages. You'd be expecting on a monthly basis to have a bit of a pullback on a monthly basis, but we know that level is there. Let's continue looking down. So the weekly is also overextended, but let's just zoom in a bit. Still very bearish, because we know that the US is so strong right now in comparison to everything else. Still very bearish, but very overextended. Daily, obviously very bearish, more in line with your moving averages. So here we had an opportunity to pull back and push down again, but we're overextended on the daily. We're going to look at the 8 hour. Now, let's first of all, all of this, you know, when you push down, sometimes you pull nicely back into the moving averages. Sometimes you kind of slide back into the moving averages. Yeah. So when you're getting sort of this up down sort of slide back into the moving averages, what it means is your time frames below are going to effectively, rather than being an uptrend when that pullback occurs, they're going to be in a range. So sometimes that happens as well. So you can identify that range here and go, right, there's the top of the range, there's the bottom of that range, or at least the bottom of the range is not so clearly defined. So you could very much take the previous, whatever the previous low is, which is there, 65.13 as, no, sorry, that was the low, that was the high, 64.16 as the low of the range at any particular time. So as long as it's trading within that range, we consider that the pullback. Now, you can't even trade that pullback because it's not an uptrend, it's a range. But we know we're in the context of a longer term downtrend. So as soon as that low, well, in a minute, at least the high is broken, because that would obviously change your sentiment. But as the higher time frames are trending down, and we know this from the moving averages, you'd be expecting more likely than not that this pair would move to the downside. So the moment it breaks that low, again 64.16 on the lower time frames, which is here, there, we've gone down. Sorry, I'm going through pretty quickly, but we've just gone down to the 4. So we know we're in a downtrend. We know we're sliding back into the moving averages on the higher time frames. That's what this is. Okay. Now, there's opportunities on the 4 hour too here. There's opportunities all over the place, depending on what time frame you're on. But you can see here, I mean, there's no opportunities on the 4 hour because we know that we're sliding back into the moving averages on the, what did we say? On the daily. We know we're here. We know we're sliding back, moving into the moving averages on the daily. The moment we break the low of that, we push down, we pull back into the moving averages, and look at what happens to the moving averages. You get this nice sort of geometric fanning pattern. In the case of a downtrend, you want to see that 10-period moving average pulled down first, the 20 follows, the 50 follows later. Now, don't necessarily have to wait for the 200 to follow, because that's obviously a big ship to turn around. I mean, that's going to take a long time if you wait. I mean, the 200 period of moving average could be anywhere. It could be down here, could even be moving up. Well, it won't be moving up if the monthly chart's doing that, let's face it. But funnily enough, illustrates my point. What's the 200 period moving average doing on a monthly basis? It's flat, because the last 200 candles are pretty flat. Anyway, I digress. Certainly on a 4 hour chart, you've got longer term, much longer term momentum to the downside. Where was I? So for the moment, it pulls back into this moving averages. Now it's not quite there on the 4, okay, but go down to the 2. Now there's the low. This is the range. You've broken out of the range by breaking the low. You've pulled back into the moving averages. This is a bit of a big candle to get in on. Okay, you can see prices. Yeah, okay, big push down predominantly. Big red candles, bearish candles, followed by indecision. Don't know what you'd call that, probably a bit more indecision. No, you'd probably call that a little bit bullish, because it has certainly closed a lot higher than it opened. Actually, that's bad data. That's bad data. If you can see that, if the previous, hold on, why have we got that? We're in October. If the previous candle ended there, then obviously that one can't start there. Sometimes maybe over a weekend, or you get a little bit of gappiness on on the charts, but that is bad data there. Really, if it ended there, it should have started there at the same point. I mean, it can't. There's 1 second between the, well, not even that, between the finish of one candle and the start of a next, even though it's whether it's 2 hour or a monthly. So anyway, really, I think that candle's a bit wrong. But anyway, point is, pull back. Then you start your pullback. Now, when you're in the range of between the 10 and 20, if there's not an opportunity on that particular chart, then go down to the 1. What does that look like? Here you've pulled back into the moving averages. You got a nice little red candle. This one here is looking better. Okay, that is a medium-sized candle, small to medium-sized candle. I mean, it's not a big candle. This is a big candle. In the middle of a run, these are the size of the big candles. This is not a big candle. So that is an opportunity. Right there, again, you're below the previous low, or at least you have broken the previous low. So you're now in a downtrend from the lower high, which was here, to the lower low, which was here. You've pulled back into the moving averages, an entry there with a stop above the high, and you can ride that down. Now, fair enough, it's come back here, but it's continued on down. It's pulled back in again, it's pulled back in again, and it's pulled back in again, multiple times until it stops. This is where I should bring in the indicators as well. 2 seconds. Sip. And this is now a 1 hour chart, and I established a longer term momentum to the downside, a pullback into the averages on the high time frames, a break below the low, and a resuming to the downside on the lower time frames, which is sort of pushed along by the high time frame momentum. Okay, so there's a trend flow pattern that we look for. There's also a breakout pattern that we look for. But let me just explain indicators as well. So, okay, when you're trying to establish the strength of a prevailing trend, and in this case, it's obviously a downtrend, you want to look at your MACD and your RSI to be giving you the same picture as what's happening on the chart action. So, okay, so let's say you're in this position here, as we were, earlier this week. I've assessed that you've had a push down and you've had a pullback into the moving averages. Now we've got really nice small candles. There's a small candle. I want to capitalize or get on the next wave down. So my MACD and my RSI, as price is making lower lows, so as I say, let's say we were in this point here, trying to capture this run. This is the most recent low, and this is the one before. Across here is good because you get horizontal and vertical axis at the same time. If we put our vertical axis along this low, oops, what happened? Along this low, and we run our eyes down to both the MACD and the RSI. Well, let's start with the MACD. The first line, the red line there, the dotted line there. You can see that as price pushes down to new lows, the MACD is doing the same. Okay, the low before it, you really want to base your trading decisions on the last two, but just out of interest, the two before it were doing the same thing. So that tells you that the strength of the downtrend is still intact. What you want to see is lower lows on the indicators or equal lows, or again, let's look at the RSI now. Where is that blue line in comparison to the push down before? Now that is a little bit higher, but they kind of cancel each other out in that case. Sometimes your RSI will give you an indication that a trend is about to end before the MACD. Sometimes it's the other way around. Certainly from this low to this low, your RSI is well and truly agreeing with the price action. It's saying this push down is stronger than this push down. They're both saying that. Here, the RSI is perhaps suggesting that it's weakening slightly, but when you get to this low in comparison to this low, so then you get to this low here, right? You've headed down to 62.5. You've pulled back into this moving average, and you think, wow, we're on our way again. What is the RSI telling you? That is called massive divergence or obvious divergence. Convergence here, divergence here. So as it pushes down to that low, you know, all of these red candles followed by a green candle. It's the other thing, and again, this is a little bit more technical. The other thing that could give you a bit of a hint is the high wicks on these pullback candles, and how it's very, even though it's a pullback, they're not particularly bullish candles if they've rejected all this higher pricing. That's another indication, but this is a little bit more complicated, but essentially that's a pullback. There's a bearish candle after a pullback, because yes, that is definitely a bearish candle right there, but you've got big divergence on well, at least on the MACD, you've got big divergence on the MACD, like obvious pronounced divergence, more so than the RSI was showing here. So that's a signal that this push down may not happen, may not be as strong as the previous one. Another thing that would obviously give you that impression would be the length of the price action between the moving averages on the higher time frames. Another thing we established before would be the massive support level, pretty much where we are now. That would be another indication of why you would be seeing this divergence on the 2 hour, on the, what was it, the 4 hour? No, what was it? You forget which chart you're looking at. On the, yeah, well, definitely on the 2 hour. You can see all this divergence